Hello everyone, and welcome back to part number 8 of our dividend investing series. We're looking at all 18 of the dividend ETFs that have assets under management of over $1 billion. Before we get to today's ETF, I wanted to let everyone know, if you haven't seen, that I do have my audiobook now available on Apple and Spotify podcast. So if you want to listen to that, you're welcome to do that for free on the podcast platform of your choice. A couple people have mentioned that the order is not correct on the podcast. So it goes from chapter 1 to chapter 7. It kind of jumps around a bit. So I'm going to try to fix that. Not quite sure why that's happening, but sorry about that for those of you that have tried to listen to it there. I will try to get that fixed. I also wanted to announce that I'm going to start doing a weekly Q&A on my podcast platform. So if you have a question that you would like for me to answer, just go ahead and leave a comment in the comment section, whatever question that is, whatever the number one thing is that you are struggling with when it comes to investing. That could be a question about dividend investing in particular, if you're buying individual stocks. Maybe it's a question about ETFs. Maybe it's a request for something that you'd like for me to cover in more detail. Just go ahead and leave a comment and I will pick one of those questions to talk about. Probably a 5 or 10 minute podcast that I'll do each week. With that behind us, we're going to go ahead and get into the ETF. Today we are on number 8 of 18. We've looked at several of these already. I'm not going to go over everything we've done. There's a playlist if you want to check out the rest of the videos. But today we're going to be doing, we're going to be doing Noble. We did Noble last time. Today we're going to be doing the SPYD ETF, the SPYD S&P 500 High Dividend Yield ETF. So in this video, just like the others, we're going to look at some basic details about SPYD, including the dividend yield, fees. We'll also look at the dividend history. So how has SPYD's actual distributions grown or not grown throughout history? How does SPYD select the stocks that it has? And then we'll also take a look at risk, so how SPYD has performed in bad markets like 2020. I'll also talk a bit about how they performed in 08-09. And then the holdings, what does SPYD own right now as of October 2020? And then we'll also look at performance, which has not been great for those of you that have owned this ETF. The performance recently has been actually quite bad. But before we jump to conclusions, I also want to show you guys how the index has performed since 1991, which is a bit more encouraging. So we'll get into that at the very end of the video. Here are the quick facts for SPYD. It's the SPYD portfolio. The index is the S&P 500 High Dividend Index. The assets under management right now are $2.03 billion. The expense ratio is pretty impressive at just 7 basis points. And then the number one reason you're probably watching this video or looking into SPYD is because it has a pretty massive 5.5% dividend yield at the time of this video. Unfortunately, the dividend history isn't very impressive for this fund. We see that, as with a lot of high dividend yield investments, what you gain in yield, you sacrifice in the long-term growth of that income. So for SPYD, if we look back to December of 2016, the distributions, the trailing 12-month distributions, we're right at, we'll say this is $1.54. Sorry, I didn't actually put the data in here, but something around where it is right this very second. So the trailing 12 months is $1.52. So most likely the trailing 12-month dividend is actually lower today in 2020 than it was almost 4 years ago at the very end of 2016. So this is not a particularly favorable picture. What we want to see from our dividend investment portfolio is that the income is actually growing. Just because it's a high yield today doesn't necessarily mean that's going to be able to be sustained in the future or continue to be increased in the future, which is really what we're going for. So this is not a good look. Now we'll take a look at the strategy. The starting universe for this index is the S&P 500, and then the only other criteria is that they have an indicated dividend, meaning an announced dividend that is at least positive. Then they take all the stocks that make it through that screen and they rank it by the highest indicated dividend yield, which is just simply the most recent dividend announcement, and then they annualize that based on whatever the company's stated policy is. So if they pay monthly or quarterly or semi-annually, it is annualized. And then they just simply take the top 80 stocks. At rebalance, what they do at the end of January and July is they will automatically include the top 80% dividend yielding stocks that are currently in the portfolio, which leaves about 16 stocks that are then up for changing. So they'll take the top 96 holdings in the S&P 500 ranked by dividend yield. Any of those stocks that are in the current portfolio, those also get kept. And then if there's any stocks outside of the top 96 that are in the current portfolio, those get sold and replaced with the next highest yielding stocks. That's a little bit confusing. So maybe you have to watch that part again. Hopefully I explained that somewhat well. But bottom line is, if it's in the top 96 in the S&P 500 ranked by dividend yield, the stock will then stay in the index. Only when it gets outside of that will it get sold and replaced with the next highest yielding position that is not already owned by the portfolio. So hopefully that makes sense. S&P also has the authority to exclude any stock at their discretion, and then dividend cuts, suspensions, or low yields are going to get removed monthly. So if a stock, cuts a dividend, obviously it loses its high yield and gets removed. Unfortunately, that will happen after the cut is already announced, which means the stock price is probably already dropped to reflect that, likely well in advance of the actual cut itself. They also will remove a very low yield, which the only example I can think of why this would be relevant would be, say, if a stock went up 50% on some kind of acquisition announcement, the yield would then go from, say, 10% to 5%, or that's a bad example, but if they went from 5% yield to, say, 2% yield in a really short order, it could get removed before January or July official rebalance comes. The diversification of this ETF, there are no sector constraints, so it does have quite a bit of exposure to higher yielding sectors like utilities and REITs, which we will see in a little bit. There are no stock weighting constraints, so if a stock goes up a lot and the weighting exceeds the original equal weighted starting percent, it won't necessarily get shaved back. It's not going to constrain that at all. And then it will always hold at least 80 stocks unless there's some kind of a spin-off or something, and then it's possible that it could own one or two more. It is an equal weighted portfolio. Now we're going to take a look at the risk of this ETF. This is probably my biggest knock against it, is just how poorly this has done in bad markets. This minus 36.56% represents how it performed from January 1st of this year to March 31st. That is not good, especially when you consider that the the S&P 500 went down by 26.7%. A couple of the other ETFs we've looked at in this series went down even less. So the winner of that downside protection so far has been VIG For reference, that went down about 17%. So we see that this SPYD is substantially more risky than the overall market and other dividend ETFs. One other thing on that, I did check to see how this ETF performed in 2008. The S&P 500 dropped by about 37% in 08. This this index, so the fund does not exist at that time, but the index dropped by 43.5%. So again, we've seen in 2 bad recessions, this ETF has done substantially worse than the overall market. So you're definitely taking more risk to get that higher yield. In the stocks and sectors that this fund currently owns, we see a substantial overweight in some dividend-centric sectors. So we see here real estate is currently at 19% compared to the S&P 500 at about 3%. The other huge overweight that we see is in the financial sector at 26% compared to 18% for the S&P 500. There's also a pretty material overweight in energy at close to 11%. And then another big overweight is in utilities at 11.5%. The industrial exposure is actually 0. It's also underweighted in technology, which is partly to blame for its poor recent performance. Most of the other sectors are pretty well in line, except for a slight underweight in consumer staples and then a pretty big underweight in healthcare. Here are some of the holdings for SPYD right this very second. The number 1 weighting, meaning the best performing since the last rebalance, is Xerox. But we do see here this list is not particularly high quality, especially compared to some of the other names that we've seen. A lot of these companies will issue equity to cover growth projects or continue paying the dividend. There's also a lot of debt contained on this list. I would not be particularly encouraged to see these individual holdings in a portfolio that I would own. Just not a very high quality list from what I can tell. Now we'll look at the performance. Here is the actual ETF itself. The data we have goes back 3 years here in Morningstar, and we see that the ETF has underperformed by about 5.5% per year, and that is compared to the Russell 1000 Value Index, which has also dramatically underperformed the S&P 500. So if we looked at this compared to the S&P, it would be even uglier than this. This is probably the worst 1-year performance I've seen in an ETF probably in a while. It's actually underperformed the Russell 1000 Value Index by 17.7%. This is as of October 8th. Just for reference, if you look at the S&P as of today, it's up about 10%. So this has not done well at all for the trailing 1 year or year to date. The index, on the other hand, has a pretty decent track record of performance going back to 1991. So again, just to remind everyone, you can look at the ETF, which tracks the underlying index, but you can also get more data going back further by looking at the underlying index. So here we look in Bloomberg, we type in SPXHDUT. That is the index that SPYD will track. So if we check how that index has performed going back to 1991, we see that it has actually outperformed the S&P 500 slightly over that time period, returning an annualized 10.7% compared to 10.4% for the S&P 500. I did have a question from one of you asking me to just confirm that the ETF actually tracks the index pretty closely. So I went ahead and showed that here at the bottom. Just typed into Bloomberg 12/31/2015 to 10/13/2020. This underlying index performed 4.44% per year over that time period. The actual ETF itself net of fees, performed 4.31%. So you are getting a little bit of a tracking error, meaning it's not owning exactly what the index owns and the exact weighting. But then the main reason for the difference is going to be the fees, which right now are 0.07%. I believe those have been reduced, so it could be that, 2015, maybe the fees were closer to 0.2 or something, which explains why this difference is 0.13% annually instead of closer to 0.07 annually. So the pros and cons of this ETF, the number one pro probably is that the index performance has been quite good if you go back to 91. It's also obviously a high dividend yielding ETF, which is probably why most people are attracted to it. I did not put that here because I think that is contributing to a lot of the kind of junky characteristics of this ETF, but it is a high yielding ETF. So a lot of you might put that here as a pro. It has low fees at 7 basis points, which is good. It also may be a pretty good opportunity right now if traditional value stocks like energy and financials and utilities and real estate, if those do well in the future, this fund will likely do well as well, will most likely outperform the index. If you get this continued push towards more technology, this fund is probably going to continue to suffer. The main cons, it does have very poor downside protection. The recent returns have been pretty horrible. It does not have any dividend growth since 2016. Actually has been slightly negative, so it's a little bit more dividend cuts. The quality of the companies leaves a lot to be desired. The high dividend yield is also probably being funded more by debt and equity issuance than it is by internally generated cash flows, which is definitely something to watch out for. And then it's way overweight in utilities, energy, and financials. So once again, if you want to leave a question for me, I will answer that or answer one of them in the weekly Q&A on my podcast. If you want to check out my audiobook, you can also do that at the same podcast. Go ahead and check that out. If you've already listened to it and you like it, would really appreciate you leaving a review for me as well. If you're not subscribed to this channel, go ahead and hit the subscribe button down below. And if you found this video helpful, I would appreciate it if you would hit the like button. It really helps me out a lot. So thanks as always for watching, and I will see you in the next video.